Hello everyone, with the Tesla stock dropping from 40% from all-time highs in 2022, and while the stock market looks like it's crashing and burning, is there an opportunity in Tesla right now? So in today's video, I want to help you decide whether Tesla stock is a good buy now or should you wait until after the stock split. I also want to go over what does the stock split really mean and give you a brief history lesson of what stock splits have typically done for other stocks in the past. And lastly, I want to go over the risks with Tesla because, every investment we make, there's always an upside and a downside, and so that you can make your own financial decision. Now make sure you stay till the very end because I want to introduce you a metric that I think any investor can use, especially in a high quality company like Tesla. So if you ever want to make your own investing decisions with confidence, learn how to value companies, learn to recognize mispriced opportunities, or you just want to hear my thoughts on Tesla, then you definitely want to check out today's video. Now before I jump into talking about stock splits, the history of stock splits, what it means for Tesla stock, I want to share my process for what a perfect stock looks like to me, because I think this checklist would be really helpful for you, especially if you're serious about becoming a more sophisticated investor. So here's my checklist. The first one is always an easy business model where you can understand it in depth, because there's so many stocks out there, and if it takes a little bit too many brain cells to understand the business model, that's probably, like, as a busy professional, it's probably not for you, and that's definitely for sure for me. So Tesla is a very easy business model because they sell electric vehicles, batteries, they work on solar panels, they also work on software, which are all things that are pretty easy to understand and understand how they make money. Now the second one is it's got great leadership and management. Ideally, the CEO is the founder. Now, this is one of my most favorite parts because it shows skin in the game. So I ideally want the CEO to be the original founder of the company. Now, technically, Tesla wasn't really started by Elon because he had other partners involved, but he's still there, and that is a strength. Okay, that's a sign of strength for me, and he owns a fairly big position still in the Tesla company, which is saying that he's got a lot of skin in the game. The third thing is, does it have a competitive edge, which is a moat, which is saying that has lots of ways that it could outcompete the market. So with Tesla, they have a competitive edge in terms of how they make the electric vehicles, because they make it a lot faster and a lot more efficient than any other electric vehicle maker out there in North America. They also have patents on their battery, on the way they make the batteries, which is proprietary. They also have their full self-driving software. Now, it has a lot of bugs, but they're the only ones that's working on a full scale. So if you think about all these different markets that they're getting into, which is energy, electric vehicles, software, you can see that they have a lot of competitive edges. Now the fourth one is multiple streams of revenue. Now who doesn't love multiple streams of revenue? Because it just makes you more resilient in any type of market. A great example of a stock to avoid is a stock that has one revenue stream. And good example is GoPro, which in the past was really popular, and the stock did well because they sold the cameras, which did really well. But unfortunately, they didn't scale or successfully scale to other revenue streams other than their camera. And so because they're a one-trick pony, they haven't done so well in the past, like 5 years. Well, Tesla has multiple streams of revenue, okay? They make revenue off of their batteries. They make revenue off their cars by selling the cars. They also have the supercharger network, the only network that's all across Canada where you could charge your car reliably. They also sell their full self-driving software. I know it's in beta, but they're the only ones who's doing this at massive scale and selling it. They also have insurance, and the list goes on and on. So basically Tesla has multiple streams in revenue. The fifth one is creating markets or killing old markets. Okay, so I use the example of Apple. Okay, Apple back in the day was really killing the old cell phone market because Apple's iPhone was a new way of saying, hey, the phone is actually a computer. And back then, people were like poo-pooing Apple, saying like, how could Apple's market cap be bigger than all these cell phone market caps? Well, because Apple was actually not cell phones, actually a smartphone. But back then, people didn't recognize that as an opportunity, that it was disrupting an old market. So what does this mean for Tesla? Tesla's doing the same thing. I think nowadays, more and more people are getting it with Tesla, but back like not even that long ago, Tesla was always compared, their market cap, compared to all the other automobile makers because they're just seen as a car company. But in reality, Tesla is a bit of a hybrid. It's got software and hardware, and they're trying to disrupt the old traditional gas combustion vehicle. And they're looking to really accelerate electric vehicles, which is disrupting a huge old market. And it's not fair to compare Tesla to all these old automobile manufacturers because they are riddled with debt and they have super low profit margins, while Tesla has really great profit margins, growing revenue, and low debt. Which gives me to the financial metrics that are super important when evaluating a perfect stock. Number 6 is the stock has performed really well in the past 10 years, which is bullish, okay? Now I know short term, the stock goes up and then it goes down and there's stock market cycles, but if you zoom out, take a look at the stock charts, the trend is really obvious, which is going up. Number 7, now these are getting into the financial metrics, which is revenue is growing. I always talk in every video that you want to look for a company that grows. Well, how you measure that is looking at their revenues and making sure it grows, which of course Tesla's been doing really, really well. Another one is you want to look for a company grows and makes a lot of dough, which is its earnings is growing. So this is after you pay out the expenses and then pay your taxes, and whatever's left over, which is called earnings, is also growing year after year. Number 9, which is lots of cash and low debt. The reason being is because if the stock market turns, which we're facing right now, interest rates starts rising, which we're facing right now, well, if you have a lot of debt, you're going to pay a lot more with your debt. It's just like credit card payments with high interest rates. You don't want the interest rates start rising if you have a ton of debt. And thankfully, with Tesla, they have very little debt, I think almost no debt, and ton of cash, so they can survive and thrive in any cycle, even during recession. And the last one, number 10, is growing cash flow. The reason why I look for companies with growing cash flow, because, well, with cash flow, you can make acquisitions, you can buy back your stocks, you can issue dividends, you can reinvest the company. So who doesn't like having a ton of cash flow? It's like you. If you happen to grow your salary and then you live under your means, your cash flow is probably growing and building up every single month. So you can deploy it however way you want it, including investing in stocks, just the same as a company. So before we jump into how the stock split could impact Tesla, I want to give you stock split 101. Now, typically a company splits a stock because for the regular average investor, they may not like the stock because it looks expensive, even though the market cap stays exactly the same. It's just so that there's new investors that, want to get in because it looks cheap relative to the share price to what it was in the past. So for example, you might have a company that has a market cap of say 10 billion, but its stock price per share is $3,000. Relative to another company, and just say this other company is very similar, but their market cap's like 20 billion, but their share price happens to be $50 per share. Now, because these two companies are similar, someone who's new to investing, who doesn't look at market caps and just looks at the stock price, will say the $3,000 per share looks really expensive compared to this $50 per share, even though as nothing, they don't look at the market cap. But to fight this perception that $3,000 is way more expensive than $50 per share, even though the market cap of the $3,000 per share is way lower than the $50 per share, the company issues more shares but doesn't dilute the company, keeps the market cap the same. I think the best example I can use is that, say you bought an apple pie, okay? Now the apple pie is just one pie, it's always the same, but you could cut it into 4 pieces, you could cut it up into 8 pieces, you could cut it in 10 pieces. The only difference is that the more you cut it up, the smaller each slice gets. And that's exactly what happens to a company, which is why they split their stocks, they issue more shares, but the relative revenue and the earnings that you collect per share, well, it's just a little bit tinier, but the market cap is still the same. So it's just like the apple pie, exactly the same pie. You just get less of it. So what does this mean for this Tesla stock price? Okay, so if we look at past history in the S&P 500, typically when stocks split, like Apple's, the Google's, the Microsofts, and the Amazons way back in the past, on average, these types of stocks in the S&P 500 have risen 5% after the stock split, including immediately following the announcement of about 2.5%. This is according to the research from NASDAQ from 2012 to 2018. So how does this impact Tesla? If we look back in Tesla, like back in August in 2020, when they officially announced their 5-to-1 stock split, what happened was a week after the stock split, the price went up 20%. By the end of week 2, it also went up 24%. Now, we don't know if this is going to continue, especially this type of market where it's lots of macro fears like rising inflation, increasing interest rates, the war happening, supply chain issues. No idea. And I would also say in August 2020, around the same time, it was also known that Tesla was likely to be included in the S&P 500. So I don't know if that also had a play there. But if we just look back at just what happened with the stocks in the S&P 500, the day the stock split was officially announced and following after, on average, they rise 5%. And if we compare, say, the performance of that stock in a 1-year return versus a 1-year return when the stock split happens, you can see that if the stock just went up 9% in that 1 year, if the stock split happens 1 year later, they tend to increase way higher than 9%, like on average 25% according to this chart. Now, given that Tesla has dropped so much, like 40% from all-time highs, if you are just looking to make a position in Tesla and wondering, is this a good value right now? A really simple thing you could do is calculate what is this forward PE ratio. And you can even use the analyst projections, which tend to be actually underestimated by like 25%. But say you're super bearish and you're like, I don't know if Tesla's going to make all those cars that they think they're going to make, well, then go ahead, use the analyst projections. Just look at the forward PE. So take the stock price of today and divide it by what the earnings per share could look like in 2023 and 2024, and you get a forward PE ratio. Now, according to Peter Lynch, who loves looking at the PEG, which is the price per earnings relative to the growth rate, if you have a growth rate of 35 to 40%, which is expected from Tesla because they are building a ton of factories, like 3 more factories that are going to be in production like very, very soon. And last year they only delivered 1 million cars and they have 3 other factories about to be like ramping up. Well, you could see that obviously they're going to grow 35 to 40% per year for the next 2 years. And that's assuming, of course, they sell all the cars. Now, if they grew 35 to 40% every single year for the next 2 years and their forward PE ratio is, around 40, well, that looks really enticing because anytime you get a price per earnings relative to the growth rate that's equal to 1 or less than 1, you could say, ooh, it looks really, really desirable. And Tesla is getting there, even using the analyst projections, which I would say I completely underestimated. So if you want to even bump up the analyst projections by 15%, well, then you can see it's getting really, really close. In fact, I think it's almost less than 1 right now. Let's talk about the Tesla risk. Now, I know I went on and on about the upside that you could get like a bit of a long-term bump in the stock price just because of splits, and the history is an indicator of Tesla's future. Well, it could get a pretty big bump. And I also talked about that, yeah, it's looking fairly undervalued right now relative to how it's growing over the next 2 years, and the fact that the production of the cars is going to be like exploding over the next 2 years. But we got to talk about the realities of investing in Tesla and, well, the risks that are involved. The number one risk I see with investing in Tesla is Elon Musk. Okay, Elon Musk is, let's just say, a bit crazy. Okay, he loves going on Twitter and talking about random things and of course even wanting to buy out Twitter. And that in itself sends a lot of volatility to the stock price because whatever he says could actually impact the stock price, even though it has nothing to do with Tesla. Number 2, Tesla's stock price is super volatile. Check out the beta rating, which is over 2, which means that if the stock market goes up like 5%, well, Tesla's going to go up 2 times that 10%. But if the stock market drops 5% on average, Tesla drops 10%. So you can see that it's a super volatile stock. And if you don't have the stomach for its volatility, then you probably want to stay away from Tesla. Number 3, Elon Musk could be leaving. Now, I know there's been previous interviews where Elon Musk says he will stay as long as he stays useful in the company. But if you check back in older shareholder meetings and earnings call, Elon Musk did say that he could leave in the next 5 years. Now, I don't think Elon Musk would actually leave the company officially. I just think he could leave as the CEO because the CEO is just managing day-to-day operations of the company and he may become the executive chair or a higher level position. But I'm just saying that is a risk in itself if Elon Musk leaves as a CEO. And of course, the 4th risk is that we are going to have some short-term pain, okay? We have Shanghai shutting down for weeks at a time, and it could happen again because they have a 0% COVID policy, meaning they want 0% of COVID cases in a city. And if they get any case, they will shut down neighborhoods. And Tesla's factory is in Shanghai. So if they happen to shut down Shanghai again, it could really impact the number of cars that could produce in the very short term, which could add some volatility, meaning downward volatility on the stock price, just as short-term pain. Now, I believe if you are a long-term investor who could stomach the volatility of Tesla's stock price and believe in the electric vehicle trend and believe in sustainable energy, moving away from oil, I really think Tesla is one of the best companies to invest in. But of course, I'm just some YouTuber that loves talking about stocks for entertainment purposes only. Everything I talked about earlier in this video is for entertainment purposes only. Please do your own due diligence and make your own financial decision. Anyways, I hope you found this video super helpful. All I ask of you is give me a thumbs up. I'll see you in the next video. Bye.